Hello, everyone. This is Kevin Gaugish, Chief People Officer for ATG, and I'm joined today by our friend at CFG, Anthony DiChiera. And first, this is the third in a series of events that we've had, Anthony. I know we recently did live version of this in Manchester and Shrewsbury. But can you tell us a little bit about the background of who you are, the history of CFG with ATG, and the services that you're able to provide to our employees?
Absolutely. Well, thank you, Kevin. We certainly appreciate the time. So for those of you I hadn't had a chance to meet with or speak with yet, my name is Anthony DiChiera. I'm the financial advisor on the ATG 401k plan. My company is Centinel Financial Group, CFG. We're actually one of the oldest independent financial planning firms in the Boston area. Got our roots back in 1967 in the Chestnut Hill, Brookline area. Currently located in Needham Heights. That's where I'm located. And our relationship with ATG goes back about 20 years, managing the 401k back with Tri-State Trucking. And at the end of the day, we are an independent financial planning firm. We provide a variety of products and services to help protect and accumulate your wealth. We take you through a process. Every individual client is different. Everybody's goals are different. So we focus a lot on education, asking a lot of in-depth questions at that preliminary meeting. What's important to you? What's important to your family? What are the goals that you're hoping to accomplish? And then we essentially take you through a process. And eventually, we'll get to a recommendation or a series of recommendations for you. And, it's a relationship building business. At the end of the day, if we end up doing some additional work together outside of the 401k, we'll continue to help, manage that relationship, meet with you periodically. As things change in your world, we're going to be here to be your advisors throughout that process.
That's great. And I must say, Anthony, you surely aged well, having been around since 1967. So well done. Maybe you can give our members some tips on that as well. So I know, all kidding aside, every year we see a series of changes that get communicated around the tax code and changes in legislation and how to interpret the tax code. Most of it has little impact on us as individuals, but I'm sure there's something this year that we should be thinking about, given the changes going into 2023. What changes in the tax code have you seen that would benefit or that we should be aware of as individuals?
That's a great point, Kevin. Usually there's a ton of changes, and the reality is it doesn't really have much impact, on an individual client. But there are two pieces, I think, this year. The Inflation Reduction Act had a couple of key changes. So the first one is that there's about a 7% increase in every single tax bracket for all brackets. Okay, so whether you're at a lower income or a higher income, married filing jointly, head of household single, there's about a 7% increase there, a 7% spread from compared to last year. And obviously with inflation, this was part of the reason for that. So essentially there's an opportunity here. So if you made the same amount of money this coming year, as you did last year, you're probably going to either get a bigger tax refund, or you'll owe less to the IRS at the end of the year. So what's the opportunity? That is for ATG members and everyone that has a 401k to save additional funds this year, because at the end of the day, your net take home money is probably going to be the same. So maybe if you're doing, a 3% contribution, maybe increase that to 5% or 6%. If you're doing 4% to get the full match, I always want to remind people 4% is the full match. So definitely do that. If you're doing 4% and you can afford to do a little bit more, maybe you do 2 or 3% into the Roth portion. So it gives you additional tax benefits in the future. So that's one change. The second one is that the standard deductions have also increased quite significantly. So for, I don't know the exact number, but the increase in married filing jointly is about an $1,800 additional deduction or standard deduction, about $1,400 if you're head of household, and about $900, if I'm not mistaken, married filing separately. So if you take a look at the tax brackets changing, and the additional deductions that most individuals have, you're probably going to get a lot more money back, like I said, at the end of the year. So maybe try to reallocate that towards your long-term retirement goals. That's one of the the steps that we can take to help really increase your savings in your 401k over the long term.
That's great. That's great. You had me worried there when you said the taxes had gone up by 7%, but it's actually the threshold, those sort of
Correct.
bands, those marginal bands. So
Absolutely.
you can earn more, be taxed at that same lower rate. So a lot of positive news, probably in general. If you're earning the same or slightly more this year, you'll be paying less taxes in all likelihood.
Correct.
Now, there's a lot of talk about the relationship between interest rates and inflation. What do I need to know as an investor, maybe as a consumer, as someone who's budgeting, about this inflation and interest rate relationship?
Great question. This is probably one of the topics I've discussed the most with my clients over the last year plus. So it's not an exact science, right? The relationship between interest rates and inflation, there's a lot of moving parts to it. But to kind of make it simple here, 2022 was a year of really, really high inflation. Some estimates are almost as much as 9%, and some of that actually excludes fuel and food, which is probably the two most volatile areas. But that being said, what happens when we have high inflation, and a lot of this goes back to kind of what happened during COVID. I think we're still dealing with the ramifications of those shutdowns. But the Fed, their number one goal is to combat inflation. I know I spoke with some of the members in Manchester and in Shrewsbury that the Fed doesn't necessarily care about your 401k, your investments, or your family's wealth. They really care about combating inflation. That's their number one goal. So when you have inflation at record numbers, we have the Fed being the most aggressive they've been with raising interest rates since over 40 years. I mean, you really have to go back to the late 70s, early 80s to kind of find a time that we're in right now. The Fed is very, the word is hawkish, very aggressive, right? So I don't know where interest rates are headed. I can't necessarily make a comment on that. However, as long as we still see the inflation numbers coming back and they're pretty high, the Fed is going to probably increase interest rates. I feel, my thought is that we're probably, the worst is behind us in terms of the really aggressive increases. But I think the Fed wants to get ahead of this and really make sure that inflation is kind of peaked, that we're moving forward in there. So, at the end of the day, maybe expect another rate increase. I don't know how many for the rest of the year, but as long as inflation remains an issue, the Fed is going to raise, and that has a lot of impacts on the markets, on your variable loans, maybe home equity line of credit, things like that.
Great. Thanks a lot, Anthony. Somewhat related, if you pick up the newspaper, or is there still such a thing as a newspaper? If you read the news or listen to the news, some days you're talking about the banking crisis and banks doing one thing or another. Next day it's the debt ceiling. I know there's meetings today. By the time this gets published, maybe there'll be a resolution there. Right. Should I, as an investor, be concerned about whether it's the banking or the debt crisis and the debt ceiling, or is that just something that's just noise?
Right. So great point there, Kev. So I'm going to take it, kind of step by step here. Let's kind of talk about the banking crisis really briefly, because this is what we've seen in the news, right, for the last few months. So back in March of this year, we had the Silicon Valley Bank. Everyone knows the name now. They essentially became insolvent and failed. And the FDIC, the government, had to take over the bank. Now, there was a lot of initial fears. The market had a, initial, drop because of, not knowing what the issue was. The reality is that everybody that had money with Silicon Valley Bank got their money back because the FDIC stepped in. Now, that doesn't necessarily mean that there's no issue there, right? There was a lot of fear. There was a lot of concern. And I think that goes back to the interest rates. When you have a Fed that is really, really aggressive, these banks are going to get impacted. Now, Silicon Valley Bank, First Republic, some of these banks that had these issues, their business model was a little bit more aggressive than the Bank of America's or the larger banks. They were catering mostly to, kind of startup companies, private equity, firms that are raising a lot of capital, right? So interest rates impact them significantly. And I think it really just wreaked havoc on the balance sheets. And you had, about three of them that really failed. Now, at the end of the day, like I said, nobody lost money. Maybe this is a microcosm for a bigger issue. There could certainly be more, banks that kind of fall this way. Although our feeling and the economists and the analysts that we speak with think that from a larger standpoint, it's not a global issue, right? It's not 2008 again, where there's a huge banking crisis with a prime debt. So I think it's more, a microcosm, certainly a concern, something to watch out for. I don't know what's going to happen in the near future, but I think that was, kind of a concern with the rising interest rates. So just generally speaking there. I'll kind of talk about the debt ceiling because that's now the new hot topic, right? There's always something in the news, Kevin, right? There's always concern, fear. That's what the media does. That's their goal. Now, the debt ceiling, this comes up, believe it or not, every couple of years. And people forget about it because it's really, made out to be this political thing. And essentially we get to the point where, we have to pay back the bondholders, we have to pay back our debt. And we are getting to the point where we're going to push through that ceiling in June. So we believe, and some of the economists, like I said, that we speak with, believe that it's a lot of smoke, but really no fire at the end of the day. Certainly, there could be some concerns leading up to that, where maybe the politicians play hardball, right? That's kind of their job. But we believe that in the 11th hour, it's probably going to go right to the end, but in the 11th hour, they will find some sort of a agreement, right? We'll reach across the aisle and both sides will come up with a solution. Is that a long-term solution? I don't know. I think this is probably going to rear its head every couple of years or so. But it's been fixed every single other time in the past. And I don't believe that there's any reason to believe that it won't happen this time. So, just as a general thing, something to be, on the lookout for, but we believe it's more noise than anything else.
Great. Good to hear. And I want to change now the focus from sort of the large macro economy and what we've been talking about to some of the things specifically at ATG. You mentioned our 401k plan. I know we've made some changes in the last 12 months to the 401k. Can you help us understand a little bit more what those changes were? We've thrown out terms like auto enrollment, share class, target date funds. What does that all mean for each member here at ATG?
Right. So as you know, Kevin, our goal as the advisors on the plan is to make sure that the ATG members have the most competitive, most up-to-date plan. And there's a lot of changes in the regulatory industry, over especially the last 5 years. So we want to make sure that we're keeping up with the times. You have the lowest cost, the best investment options, the best plan for you. So that being said, there was kind of three, areas that, maybe hear some of these terms, you want to understand what it is. First is auto enrollment. So as of January 1st of 2023, all new members into the ATG plan, including the members that came over from the merger, they will automatically be auto enrolled at 4%, going back to that match. That's that key number. If you remember anything, it's 4%. So all new members will have a 4% auto enrollment. If they decide that they really can't afford it, we certainly understand that. They would have to go in and kind of manually, it's almost like a negative consent, manually change that. But we believe that it gives you that motivation to really be invested in the plan day one. You have a great plan with ATG, very cost effective, some great investment options. So take advantage of it. It's almost the motivation to try to get you to do that. So that's auto enrollment. The share class, we did this change actually about a year ago, Kevin. So we noticed that the assets in the plan were accumulating. Everyone was contributing more and more. It was a good number, and we were able to decrease the cost. Our share class right now is what's called R6. Whatever that means to you doesn't necessarily mean anything in terms of the name. All you have to remember is that you are getting institutional share pricing. What that means is it is the lowest cost that we can offer in any 401k plan. We've cut the cost significantly as the plan has grown, and it's very transparent. We want the clients to understand what you're paying in terms of your fees and your costs. So it's there right on the statement. It's very transparent. We believe that transparency is very important, but you have basically the pricing that a a firm with billions of dollars investing in these companies would have access to. So very, very competitive. It is the lowest share class that we can do in terms of cost. So that's a real benefit. And that gets passed on to all of the members. Target date funds represents about, last time I checked, about 80% of the plan assets. A target date fund, I know I explained this in person, is a way to invest that as you get older and closer to retirement, your portfolio automatically becomes more conservative to account for any sort of volatility that you may incur in the later years. So I give an example. If you're a young member, just new to the plan, maybe you have a target date 2055 fund or a target date 2060 fund. Looking into the future, that's going to be around the time that you retire. So it's going to be very aggressive right now, but as you get older, it's going to be more conservative. And American funds, which is your provider, they will automatically adjust the allocation. It's kind of a way to set it and forget it in terms of your investments over the long run. And we see, 80% of the numbers go into these target date funds. American funds is a leader in the target date space, so really great investment options. But maybe if you're close to retirement and you have a 2025 fund, that fund is going to be much more conservative. Maybe it's 50, 60, 70% bonds or fixed income versus the 2060 fund, which is, gives you a lot more time to grow in the market. So we love the target date funds. It's a really great solution. If you have individual questions about, individual funds, we could talk about that. But if you don't know what you want to do and you just want a really simple automatic solution, target dates are a great option.
Great. And I'm glad you mentioned the point around the cost of the funds being more transparent, because I think that was a change.
Absolutely.
Really first was seen in January for Q4 of last year, and now more recently in April for Q1 of this year, where people saw a line item. Before, they were still paying it. It was just buried in the fee for the load of the mutual fund, I think, or something like that. Right, Anthony?
Absolutely. It was kind of embedded in the operating cost of the funds itself. And, there's been a lot of regulation on 401ks. The industry wants the clients to know what they're paying. And we believe in that too, right? Transparency, understand what you're paying for, what your costs are. But at the end of the day, it was quite a cost reduction. And now you can actually see it all there. So we believe that's best for all the members.
Great. Thanks. Sort of maybe more general again on thinking about investing. You hear terms like invest for the long term, dollar cost averaging. This is what I hear when I research investing. What advice do you have for any of our members, myself included, about 401k investments and that idea of dollar cost averaging or investing for the long term?
Absolutely. So I'll just start by saying that a 401k plan is a tax-deferred retirement vehicle. It is not dedicated for the short term. It's not, a liquid account that you can access. The IRS, not us, but the IRS says that you cannot access your money until you're 59 and a half years old. So if you're starting investing at 30, you really have, till 60 years old, basically about 30 years to take that money. So we talk to our clients about having that long-term approach. Short-term market trends happen. They've always been there. We go through periods of growth and we go through periods of recession. As a matter of fact, if you look at, a 4-year rolling average of the market, you can pretty much expect that one of those 4 years is going to be a down year. It's just what happens. It's how the market works. But then they inevitably are followed by recovery. So we want our clients to take a long-term approach, understand that even when there's a down market like in 2022, don't forget you're still contributing, you're adding money, and that goes into the dollar cost averaging. So dollar cost averaging is just a fancy term that means you're investing a fixed dollar amount, right? So if it's a 4% a 4% contribution, you're doing 4% every single pay period, right? So as the market goes down, you're actually buying the mutual funds or the underlying securities on sale. It's a cheaper cost to it. And as the market increases, you're actually buying a less amount of shares or a lower amount of shares. So at the end of the day, dollar cost averaging is a strategy that everybody in a 401k plan automatically does without even knowing it. but it's really a time-tested strategy to lower your cost over the long term, buy mutual funds when they're on sale, so to speak, and really help to grow that money over the long run. So again, long-term focus with the 401k. Don't look at it as a short-term vehicle. That's why the IRS gives you those tax benefits, and really focusing dollar cost averaging, really great strategy for long-term success.
Great, great. And you mentioned the matching piece, and I wanted to just remind people and maybe ask you a follow-up question. We've changed the timing of the company match to the 401k. Historically, it had been well after the year end. And starting in 2023, we made the match for 2022 in March. And then the first quarter match, we actually matched the Q1 contributions in early May. So a lot quicker than in the past. And it's under a safe harbor plan. What does safe harbor mean?
I mean, at the end of the day, this is a 401k plan that you are allowed to have a match in. It is a non-discriminatory plan. I think that's kind of the legal term for it that people hear, where it's available to all employees and all members, no matter what your salary is or time in the plan. You have a 4% match across the board for everyone. It's not allowing the senior management, for example, to have a higher match, and you have to wait to get a match in the plan when you're younger. Everybody is equal in the plan, and it is a non-discriminatory plan, which again is a regulation, under the kind of the IRS guidelines for 401ks.
Great, great. And then that match is automatically vested, so there's no waiting period for that match.
Correct.
As well. Great.
Correct.
So we're going to switch from investing and taking sort of funds to invest in investments, and really talk about what some might regard as a rather dismal or depressing topic, that of life insurance. It's important to consider, I understand that, but there's term life, there's whole life, there's universal life. I mean, I'm confused enough with the 401k stuff, and now you throw in all of that. What do I need to know that's right for me? How much should I be buying? What's the formula?
Great question. So maybe everybody can have a sip of coffee to kind of wake up a little bit. I promise you, I will not bore you with the details. I want to speak very generally here, just understanding. I know Mark spoke about this in person a little bit more, but we are here if you have specific questions regarding your situation. Everybody's goals are different, but a very general rule of thumb is you take a look at your income, and it's maybe 7 to 10% of your income. So I'll give you a very quick example, okay? If your income is $50,000 a year and you want to be insured at the highest level, 10-time multiple, right? Maybe it's $500,000 that is your number. Now I'm gonna take a step back. That doesn't mean that you have to have $500,000 right off the bat. It's just a general rule of thumb. And it's not a sprint, right? It's like you're climbing a mountain. You don't climb the mountain all in one day. Maybe you have a little bit of insurance today that you can afford. We're not components of overinsurance. We want you to have a really good level there between, affordability and coverage. But as maybe you get older and your income increases, you can also increase your insurance. It's very flexible. So, general rule of thumb, 7 to 10 times your income. And don't forget, if you have a work plan or a, employer-sponsored plan, or maybe a policy you picked up or your parents picked up for you years ago, you subtract that from your total need, and then you kind of find what that new number is. So there are a lot of calculators out there. If you could just Google very simply life insurance calculators, you might get a variety of different, numbers, but that's kind of a general guideline. In terms of the types of insurance, there's a really detailed conversation, so I'll kind of spare the details, but essentially it's term insurance, which is renting a policy for a period of time, 20 years, 30 years, and then at that point, after the 20 or 30 years, it expires. Or there is your permanent insurance. A lot of people have the term whole life in their mind. That was the old school way. It's not necessarily whole life insurance. It's universal, variable universal, different types of insurance policies that are permanent. They are more expensive, but they carry cash value accumulation to them. A lot of good tax benefits there. If you surrender your policy in 20 years, you get all of that cash value back. So again, not to bore with the details, it's most important to have the right amount of insurance. That's what your family needs. And then secondary is how do we put that in place based on your budget?
Got it. Great, great. And speaking of budget holistically, we've talked about various components. You mentioned food and gas earlier, inflation, and then we talked about rental, investing, insurance. As I plan about those components, what's a guideline for how much each bucket should be? And I know that varies a lot, but what advice do you have for budgeting?
Right. Well, in terms of insurance, I will just say do not overinsure yourself. Do not put yourself in a situation where you can't afford that monthly premium. Take a look at your income. I would say maybe 2.5 to 5% of your income at a maximum. This doesn't have to be, a cost that you feel like is that doesn't have value. This is important to your spouse, your children, your family from an estate planning standpoint, but maybe 2.5% to 5% on a higher end of your income is kind of what you should be looking at. So that's kind of the insurance. With if you look at a lot of these online calculators, they maybe say, okay, 50% of your income is your expenses, right? Your required expenses, food, rent, shelter, all of those things. Maybe 20% is discretionary spending, vacations, going out, social events, things like that. If you could save 30% of your total in terms of your 401k savings on the side, things like that, that would be a really, really great number. That's probably quite aggressive. Maybe looking at saving 15% of your income, I think, is a good start. And again, as your income increases, you increase your percentages to your 401k or your other outside savings. I think that would be a really safe number to help you out long term.
Great, great. And again, going all the way back to the beginning, this year, we might have that advantage of having a slightly lower tax rate to help either if you don't have your insurance set up the right way from a life insurance, this is a good time to look at that, or increasing that investment from 4 up to that 15% level. Not all in the 401k necessarily, but across your investments. So yeah, very good conversation today. I appreciate your time. Now you talked a lot about CFG, you and Mark and the team there being available for us. Is there any cost to that for our members, and how would they go about contacting you and starting that process?
That's a really great question. I spoke about this in Shrewsbury and Manchester as well. Because ATG has this relationship here with Centinel and through the 401k plan, we do not charge any financial planning fees or consulting fees to sit down or have a phone call. As a matter of fact, there's been a number of clients and members that have reached out to us over the years and have become individual clients as well. We incorporate their 401k into the plan, but it's not just, it's the foundation, but it's not total of all of your assets. So there is no cost. This is a free service to the members. If we do additional business and there are additional things that we talk about, we are fully disclosing all of those potential management fees or costs associated with it. But we do all of the work up front, Kevin. We meet with individuals, however long it takes to get your plan in place. That's what we do as an investment to all the members. So take advantage of that. At the end of the day, if you just want to see where you're at right now and you have a couple of simple questions, even if you want to hop on a Zoom or a phone call, we're more than happy to do that. We're obviously open to do in person as well, but just in the matter of time, we're happy to do that with all the members. So again, no service charges or financial planning fees for us to consult with you.
Great. And your contact information we'll provide to the members afterward, but what's the best way? Call, email, what's the best way?
Yeah, so great question. So if you want some more information, obviously about our firm, sentinelfinancialgroup.com has all of our services, all of our information, our locations, a little bit of our history, but really it's just reach out to me directly. I think, Kevin, you're going to provide the phone number and the email here. Shoot me an email, maybe put ATG, member in the head, in the heading there, or the title. I'll reach back out to you, or I'll have a member of my team reach back out, and we'll find a time to talk. It's really that simple. So phone call, email, whatever works best for you. We're open to that as well.
Very good. Very good. Well, hopefully this has been a informative discussion for all of our members. Any final words before we close today, Anthony, from you and the team at CFG?
Look, we appreciate the relationship that we've had with ATG over the years. I know there's been a lot of changes and we've really wanted to focus in on the members. This plan is dedicated to you all, right? We lowered the fees, we lowered the costs, we're adding investment options as things happen. So thank you for the relationship. Thank you for the opportunity. We look forward to a really long and prosperous relationship with all the members, and use us as a resource at the end of the day, as little or as much as you wish. That's what we're here to do.
Very good. Well, thank you, everyone. Thank you, Anthony, and the team there at CFG. Hopefully everyone found value of this. We'll be continuing these seminars both in person and virtually over the course of this year and going into 2024. Have a great day, everyone. Thanks.
Thank you.
Say make money, money, make money, money, money. Make money, money, make money, money, money.